So Ganesh, I loved reading your book, and I just finished it 2 days ago. One thing that kept coming to my mind was that as a serial entrepreneur who have been behind such major brands, Porsche Medical, um, BigBasket, how did you decide, or rather, why did you decide to write an entire work on disruption? How did this theme come to your mind, and why did you decide to choose this particular theme over so many others that sort of exist for an entrepreneur to comment upon or to write about?
Yeah, thanks. Now it's a pleasure for me to be here. So, what was happening around me was with this rise of new business models. There has been a widespread curiosity, and there are a lot of questions about how these new models work, why are they valued at such high levels, whether loss making ventures are sustainable, how existing legacy businesses can transform using these new approaches. So, this was often asked question. And I used to get these questions from people across different backgrounds. The entrepreneurs who are struggling to raise capital for their profitable ventures while watching loss making startups secure hundreds of millions of dollars. I also have seasoned industrialists running profitable businesses with strong brands for decades, but they are unable to command high market valuations. Or just young next generation business owners fascinated by these new business models, eager to integrate them into the traditional businesses, uh, second generation, third generation entrepreneur families. Traditional business owners, bookstores operators, kirana stores, travel agents, stockbrokers were facing existential challenges from new business models and want to understand them better. So these questions often used to come up when I used to speak at conferences or when I used to go outside. So that is when the idea came up. Uh, there were very few books talking about this disruption with new age business models. So I decided to combine two things, my own experiences of building some of these businesses like BigBasket, Bluestone, Homelane, Portia Medical. And also I teach at IIM Bangalore and Indian School of Business, Hyderabad, these topics. So that's how this idea came up. It's meant for a general broad audience, from entrepreneurs to startup founders to traditional industrialists, and anybody who is interested, including a retail investor who wants to invest in the next Swiggy, Zomato type of IPO, but is not able to evaluate whether the earnings per share is good because there are no earnings. So the EPS is zero or negative.
Great. Now, my next question has two parts. Now, I'll ask the first part, and that is, as a country, do you think we have embraced disruption, or are we still, in some sense, lagging behind? The second part of it I'll ask, which pertains to the Indian businesses in particular, but as a country, in the level of government, for instance, have we understood what disruption entails and the response to it, according to you, have has that been appropriate?
No, I think I'm very, very bullish and very appreciative of government's initiative, irrespective of the political party or affiliation, irrespective of whether central or state. I have seen consistently that we have managed to leapfrog in the entrepreneurship startup ecosystem space compared to most of the other countries. And let me give you two or three instances of example. One, this entire digital public infrastructure, whether it is you call it DPI, Aadhaar, KYC, resulting in the ability for small entrepreneurs to build on top of the available digital public infrastructure has been a great boon. I think one of the biggest things that's happened in India for the startup and entrepreneur ecosystem and also for the common man is this entire digital public infrastructure, which again, without getting into politics or who is to get credit for it, the fact that it was started by Nandan Nilekani in the earlier Congress government and then it was continued in this government, that has become an envy of the world. So the fact that during COVID we were able to do direct benefit transfers, the fact that we are able to do UPI transaction, digital payments, we are able to open bank accounts, the eKYC. The entire digital public infrastructure, I think, is the single biggest, most significant thing the government has done to be able to help the ecosystem. Exactly like in US or in developed countries, if you see, when did entrepreneurship and trade flourish? When the railroads were built, when the roads were built. India, of course, lags behind in physical infrastructure. I live in Bangalore, in the heart of Bangalore, among potholes and all that. But public infrastructure is the envy of the world. So I think government has done an excellent and great job on that. Two, lot of pronouncements, initiative, moves, even though they may not have deep impact, have sent the right signal to put the startup ecosystem, the entrepreneur, right on the forefront, on the front page in front of media. That has also really helped. The fund of funds, the government opening centers of excellence, whether it's for deep tech or AI or space tech. Many of the initiatives like the production linked incentive scheme, Startup India initiatives, lot of these, all of them are good signals. So at one end, we have a strong public infrastructure, digital public infrastructure, two multiple pronouncement and importance given to this. I think it's a phenomenal work that has been done by government. There is a lot to do. If I want to be, I have a big wish list in terms of, the angel tax, the ease of shutting down business and all that. But keep that aside. To answer the question, the effort and the ecosystem and the initiatives being done is definitely helping and is praiseworthy.
Now let me come to the second part of the question, which is in the realm of these new age businesses. Now, one of the important key takeaways, rather, that I could extrapolate from your book is how disruption enables or helps in the rise of new age businesses. That's one of the important themes that you sort of touch upon throughout the book. It's very clearly visible. However, to the example of COVID, for instance, COVID, if you see as a disruption, as a black swan event, led to the rise of multiple new sectors, for instance, EdTech, right? And many new companies came on board with the rise, with that disruption, embraced it, tried to innovate on top of it, and saw phenomenal numbers, these new age businesses. But the moment somehow or the other the disruption becomes a normal, right, it no longer remains a disruption, it becomes a normal, and the world gets into this normalized phases, you see some of these companies, some of these sectors struggling to understand this new reality as to what has hit them. So how do we understand this disjunction, Ganesha, somebody who has uh, been at the forefront of these businesses, who have ideated, thought about it? How do you explain this uh, the word, the exact word that I'm looking for is actually the complexity. Like, are Indian businesses, new age Indian businesses, still struggling to understand the complexity of what disruption entails?
Yeah, no, that's a valid point that COVID was a black swan event or a once in a century pandemic, caught us all by surprise. The sudden lockdown and unprecedented environment, change in consumer behavior, external factors that impacted all of us. I think there are three parts to this question. One, clearly because of the forced lockdown, suddenly people's consumer behavior changed. It had to change because there was no other alternative. Take an example of our own company, BigBasket. We had Shah Rukh Khan as the brand ambassador, high profile, high decibel television media advertising using Shah Rukh Khan about how you can buy groceries online. And years of doing hundreds of crores of spend, consumer behavior did not change, not just for Big Basket, even for e commerce, Amazon, Flipkart, disproportionate media advertising and push, but still single digit penetration of e commerce and e grocery. Suddenly, a black swan event, COVID happened. There was no choice. Physical retail was not available. Mass adoption took place. So, consumer behavior changed because of force. Same thing we saw in digital payment. Digital payment, UPI, Paytm, others did not come up during COVID. They were there before. But COVID forced the use of digital payment. Now, So some of the impact of COVID or Black Swan event was change in consumer behavior, which otherwise would have taken 10 to 15 years, happened in a matter of 1 to 2 years. So we accelerated consumer behavior change and adoption by this. So that was one aspect. The second aspect is obviously because of the short term disruption due to COVID, some of these sectors had huge tailwinds. Example, you talked about Edtech, telemedicine is two, teleconferencing, Zoom, or the way we are doing it, all of them is three. So a lot of these sectors are manufacturers manufacturing sanitizers or masks. They saw such a huge upswing or tailwind. Obviously, it was known to everybody that this is not going to last forever. This is during this particular time. It is like saying during Kumbh Mela, which is topical, there will be need for certain items in that area. That's not going to happen for the next 12 years and maybe 144 years at the same scale. That was well known. Okay, right? So that is also accepted. The third aspect was return to normal. People anticipated certain return to normalcy behavior. What has caught us by surprise is it is not just return to normal, certain abnormal behavior. You have heard of revenge tourism. Look at the hotels rates now. Look at the travel industry now. They are far above what was there pre-COVID days. Whether it is revenge tourism, whether it's people propensity to spend money on experiences because they have seen COVID, impact of COVID, death, loss of dear and near ones, they want to enjoy more. So there is a lot of one-time shift that has happened in mindset about where people are spending more on experiences and this. So these are three different aspects that we did not anticipate. As far as specific business models seeing highs and now seeing lows, there are additional reasons. Money was easy. All of us got carried away. We raised lot of money at very high valuations, which were not tenable. And when things started returning to normalcy, and sometimes with a lot more than what we expected as return to normal behavior would be, now money has become costly. Companies are struggling because the demand has gone down, the market euphoria has gone down, supply of money has gone down. Therefore, companies and business models that were built on the basis of COVID euphoria, high growth, are struggling to see in many sectors. Edtech is one example. So that there is a bit of uh, euphoria that we got carried away during the COVID with the new age business model, which has come down to reality. And you've seen that in correction of many of these new age business model stocks. And right now we are going through a cycle where new age business model valuations are slightly under stress. Raising money is difficult, but that is okay. That is par for the course as up and down in the business cycle, investment cycle, valuation cycle keeps happening.
I think that's a fantastic, very well put and thought out explanation, Ganesh. Uh, Now let me come to the other part. Now, the way in which I have structured your book in my mind is that, there's a beautiful flow of the explanation of disruption, and then from there you take into the emergence and working, how they work, the new age business models and how they work. So to come to the latter part, now you've spoken about disruption, you've seen its impact. Now if I come to the new age businesses, uh, normally new age businesses are seen as a binary opposite of legacy businesses. Very recently, in the recently concluded Karnataka Investor Summit, for instance, Nikhil Kamath also spoke about that, and we have seen this has been a conversation that has dominated any. I mean, has dominated the debate completely. Do you think, as a serial entrepreneur, as one of the foremost member of the new age business models, is this a right way to understand it, or are we somehow missing missing the big picture?
So I think what has happened is uh, two or three different things. One, clearly consumer behavior, expectation, how they like to be treated, how they like to be served has changed. Okay, right? With the advent of mobiles, smartphones, apps, internet, convenience, whether you call it 10-minute Q-commerce, whether it is ordering online, whether it's booking tickets online, or consuming uh, media, content, entertainment instantly at the moment that you're sitting, that has become the norm now. So that clearly has changed. Two, the availability of smartphone as a device, grabbing your attention, that is the place where every individual is spending more and more time. Low cost smartphone and almost free data bandwidth in the Indian context, making it available to the poorest of the poor is again a reality. So changing consumer behavior, technology, internet available at low cost in the nook and corner of the country, both of it is a reality that is real. Two, from the point of view of the business models, because of these factors, companies and organizations have discovered newer and different ways to serve the consumer which did not exist over last 1 century. Whether it's a platform business model, I talk about it in the book, platform business models versus pipeline business model. Traditionally, for hundreds of years, businesses were built as vertical full stack businesses. Consider Unilever, consider Procter and Gamble, consider Tata Chemicals. What was the standard means and methodology? Buy land, set up a factory, create a brand, do advertising, establish dealers, distributors, wholesalers, channels, and selling. Full vertical integration. Okay, right? That's a traditional pipeline model or car manufacturing. Okay. Now, or hotel industry or banks. Now you're talking about because of technology, because of internet, because of platform business model, you no longer have the vertical full stack business. Or I would say that's not the only way to do business. In the platform business, the platform company stands in between, does not own the asset, does not have the full stack, does not have the pipeline business model of capturing the full value chain. Platform business model stands in between, connects the two sides, the producer side, right, or the supplier side, and the consumer side, okay, right? So connects the two sides, make transaction happen between both sides, stands in between, facilitates transaction, exchange of information or data or goods or services, and makes money in between. Swiggy or Zomato, Uber or Ola, right? Not owning cars, not owning restaurants, just acting as in between two sides to facilitate an exchange and do that. Now that is real. So all these developments are real, along with the fact that people are fine not owning a car. They're okay if it's available at short notice to rent it, doing an Airbnb or OYO. They're comfortable with it. People are happy working in a gig economy. Okay, right? They are working on a shared space. Okay. They are happy to rent instead of buy. So all of this meant there is real dominance, emergence of new age business model with new metric, with new drivers, with new expectations for the new age consumer. And it is daunting, it is new, it is different, it's challenging for existing players, but it's the greatest opportunity for entrepreneurs.
Which is why, because of this, the platform businesses also have their own metric of measurements. And you have spoken about this very elaborately in your book, like, for example, customer acquisition costs, average revenue per user, MAUs, DAUs, all of that, the whole host of metrics that come into play. Uh, Talk to me more about how these metrics help us in understanding and gauging the quality and quantity of what these businesses, these new age business models do.
Yeah, this is a really a fascinating topic because for hundreds of years, standard business model as defined by management theorists, whether it is Michael Porter, whether it is Philip Kotler, all of them based on standard 100 years of management theory. What is that? You had economies of scale, you had return on capital, you had return on investment, return on equity, and standard metric in stock markets, earnings per share, price to equity ratio. Now we are talking about completely different businesses. We are talking about businesses where there are no earnings, therefore there is no earnings per share. The capital is not invested because Swiggy or Zomato is not investing in the capital at the restaurant end, so they don't have capital invested. So really those metrics go for a toss. And the standard economies of scale definition, which is you get operating leverage because as you revenue grows, your fixed costs get amortized over larger and larger volumes, so you become more and more profitable. The standard supply side economies of scale is no longer applicable. That's why there is a need for new age metrics. Also, from a retail investor point of view, for anybody's point of view, how do you compare a business that makes no money when there is no earnings per share? So that becomes a question. So here is where the platform metrics comes into play. What are they? The economies of scale, standard supply side economies of scale get replaced by network effects. How does, when you are a platform in between two sites, how do you build network effects into your business? How do you bring virality into your business? What is a viral coefficient? How do I make so that every time I acquire one customer, it not only adds value to the customer, it adds value to the rest of the people. So typical two-sided network effects is a very important play in a platform business. Now that is not there in traditional business. It doesn't get captured. There is more economies of scale. Take for example, Uber. More the drivers join, more it is better for the rider or the consumer because its wait time is less. So if the wait time is less, more of us will use in our locality Uber because the wait time is less. Now, because more of us are using in that locality, more drivers will like to come in and be present in that locality. Why is that? Because for drivers, having more riders or consumers is great because they will get more rides. They will earn more money per day or per hour that they work. So you see this network effect, more of one thing adds value to the other and vice versa. So this is almost like a flywheel effect or a virtuous cycle that keeps feeding on each other. Okay, that's a great example. Take for example, Flipkart. More sellers are there. You and I will find more options available, more products available at prices that we want, more ratings. We can choose what we want exactly in our budget, what our liking. It's great for us. So we will not go outside. We'll come to Amazon or Flipkart because we know we want everything there at every price point that we want, at the quality that we want. So we will come there. Because we all come there, if a small businessman would like to come to Flipkart and list it on Flipkart, and more businessmen will come and SMEs will come on Flipkart because more and more people will come in. It's more attractive for us to shop on Flipkart because we shop on Flipkart comes in. So this flywheel or virtuous cycle getting set up, the network effect is a great example of this. So virality coefficient, network effect, how to add value, how to create a self-sustaining flywheel. All of these metrics become very critical and important in platform business model. It's very fascinating to read it. And there are ways in which you build it into your product. You build virality into your product. You build network effects into your product. I mean, of course, the product, the service need to be able to allow it so that you can grow the business very fast. One of the reasons for dominant valuation of a Swiggy or a Zomato or globally Airbnb, as you see it, is because of the network effect of winner takes all kind of a nature of the platform businesses and how they keep scaling.
One question though, this is on the other side of the question that I raised earlier. You see, at least this criticism has actually come from the legacy businesses and business owners that new age businesses don't have a robust corporate governance structure, for instance. Right. And we have seen some examples in the past, though those examples, we can't extrapolate them to speak about the large businesses in general. I mean, I can't generalize that. But still, walk me through the needs that a new age business model can actually learn from a legacy business in terms of making its structure, making its corporate structure more robust, more attuned, so to speak, with global standards, etc.
Yeah. So, no, that's a good question. In fact, I would say that while for all the hype and glamour and the excitement we talk about new age business model, there is a lot to learn from legacy business models. So people are built, and even today we have a lot of very strong, enduring legacy businesses, whether it's in the automotive, whether it's in two-wheeler, whether it is Tata Group or the Birla Group, companies that are there, many of them, the standard brands that exist, have excellent learnings, excellent best practices for all of us, including new age business models to learn from, not just in governance, in terms of learning. And while we just talked about metrics, even in metrics, while there are new age metrics, some of the enduring metrics like return on capital and profitability, return on equity are still extremely important. The only thing is, at the earlier days, initial days, you cannot use that only. You have to use things like new age metrics, contribution margin, and all of that to evaluate a business. But eventually, they will have to be answerable to the old age metrics. Coming to the corporate governance question, I think it's a fair question. See, one of the things that startups or disruptive companies, by nature, they are disruptive. So they will fail fast. They will do things, experiment, may fail, will take lot more risks, and therefore will not have, especially in early stages, the same systems, processes, governance, all of that that is required to be able to build a robust business. Okay, right? That's the nature, because if you put all those governance structures in a startup, or even regulatory framework on a startup will never take off. Okay, right? So they have to be given the flexibility. But the criticism and the question that people ask is very valid. What has happened now that we have extended the term startup, and we have started hiding behind the term startup to stay under the radar, even though we are no longer a startup. While you may be a new age business, would you call Zomato, Swiggy, BigBasket, Paytm, or Oyo a startup? Not really true. Okay, right? They are large in scale. So I think what is needed in governance is, while we should keep the ambit of governance light for early stage startup, the moment a startup acquires a critical mass, reaches a certain critical size, it could be in terms of number of employees, revenue, number of funding, number of customers, complexity of operation, or number of transaction. You can choose what is the metric or what is the threshold level. But when it becomes a certain size, we should not hide behind the radar of a startup to let go of strong systems, processes, big four auditor, governance, and all of that stuff. I think that is the mistake that has happened in the startup ecosystem, including me. I am also guilty of it. So what we need is an understanding that beyond a certain level, the startup should be held to the same accountability like any public limited company. Today, fortunately, in India, for a public limited company, thanks to strong governance by SEBI, we have very strong governing rules. You need to have an independent directors on the board. You need to have auditors. You need to have quarterly statement. You have enough thing available. Even then, there are challenges, but at least the robust governance system exists for publicly listed companies. So my this one will be, once a startup goes beyond a certain threshold, even if it's not publicly listed, we should bring in the same governance mechanism. Take one example of board of directors. What happens in a startup board of directors? You have founders and management on the board. You have investors who have put money on the board. So all these startups, even at late stages, just pre-IPO stages, have only two constituents: management and founders who are running the company, investors who have put money into the company, and investor nominees who have put money into the company. Now, that is lopsided. Because why? There is nobody taking care of the interests of the consumer, of the employees, of the environment, of the ecosystem, nobody else. There are only two constituents. There are no independent directors, because by nature, the nominee directors of the investors are supposed to protect their interest, which is the investor's interest. Okay, so they will not let the whistleblower blow the whistle. They will not rock the boat because their investment is at risk. The founder and the management are running the show. They are close to the business. They are part of the system. So they are interested in ensuring that thing runs. But what happens when things blow up? The rest of the constituents, whether it's the consumers or it's the employees or it's the customers or vendors who are given credit or the people who are given credit to business. We have seen in one large Edtech, the lenders suing the company. Nobody is taking care of their interest on the board, which in a public limited company, which is even though it's public at a far lower valuation, far smaller, has got because of SEBI regulation the thing. So this is one example. So I think we need to classify a startup into early stage startup. Beyond that, hold them accountable to the same rigorous standards.
That's a fantastic answer. According to you, what is the next disruption and how is it going to change our world and particularly Indian businesses, and what do they need to look forward to?
Any sector or
No, in general, because, and I mean largely because you deal with, because you are part of the new age internet businesses. So at least walk me through that next disruption, which according to you is already happening or is in process right now, and Indian startups, Indian new age businesses need to watch out for and to respond to.
no? So I think there are in the coming years. I see three major disruptions that will fundamentally reshape industries and business models. I mean, I'm talking the macro level. Again, this is one man's view, standard. I have more often than not proved to be wrong. So take it with a pinch of salt. And biased one man's view, not the last word, not the only word. And past history shows I've been more wrong than right. But let me share my three areas. One is this entire generative AI and agentic AI solutions. I see phenomenal fundamental change coming up. What do I mean by that? I think these are redefining work and organizational structures. Okay, right? And in my view, one of the most transformative shifts will be adoption of generative AI and agentic AI solutions in the organizational process. It's not about efficiency. Okay, right? It's about complete restructuring. Companies will now begin to unbundle tasks traditionally performed by human beings into smaller, modular tasks that can be assigned to AI agents working autonomously and collaboratively. Okay. These agents will not just automate repetitive tasks, but will also take on complex goal-oriented process such as project management, customer support, operational optimization. Okay. This shift will allow organization to transition from traditional hierarchical structures to more dynamic networked organizations where you will find AI agents interact with teams seamlessly. Workflows will be dynamically optimized. Okay. It will increase productivity without proportional increase in labor costs. So human employees will be freed from routine tasks, enabling them to focus on creative problem solving, strategy, and innovation. There is going to be huge churn in workforce, the kind of employability workforce because of these agentic AI solutions, and opportunities to build generative AI and agentic solutions will be huge. The second area where I see a huge amount of disruption happening is an entire clean energy, which will be an expanding ecosystem and secondary business models arising out of clean energy. Okay, the clean energy revolution driven by increased environmental concerns, technological innovation, government mandates. This will go beyond the first wave of renewable energy. We are already seeing electric vehicles and all that stuff. It will cascade into secondary business opportunities. The rapid growth of clean energy sector will give rise to demand in battery technology, energy storage, grid integration, recycling. Take, for example, the EV ecosystem, electric vehicle ecosystem. It's not just limited to car manufacturing or two-wheeler manufacturing. Battery production, the charging infrastructure, battery swapping networks, battery recycling, all of them will play a crucial role. Okay, right? And each one of them is a derivative demand. Okay. You have seen startups like Redwood Materials, which is already focusing on recycling lithium ion batteries to extract the minerals such as lithium, cobalt, and nickel, ensuring sustainable long-term supply chains. So the clean energy secondary business model derivative demand is huge. Government are also expected to introduce strict regulations on battery disposal and recycling. right? So compliance-driven opportunities for businesses in waste management, resource recovery, right? So cross-sector innovations will emerge. Solar-powered EV charging station, vehicle-to-grid energy transfer, improved energy storage. So very bullish on clean energy, not just the main primary demand, but secondary demand. The companies who are catering to all of this will do that. So solar powered charging stations, for example, in public areas, all of them will be there. The third disruption that I see, which is major, again, is modular building blocks and collaborative ecosystems. What do I mean by that? See, the traditional model, we talked a bit about it. Vertically integrated companies controlling every aspect of the value chain is going away. More modular collaborative approach is coming up. Okay. What does that mean? Modular ecosystem will allow businesses to build specialized component. Okay, technology module, APIs, services built by different people that can be largely and easily integrated into bigger solutions. So almost think of it like a Lego block approach that facilitates faster innovation, scalability, and cost sharing. So companies will start, instead of being vertical, full stack, will focus on their core competency, collaborate with external players to build complete end-to-end solutions. For example, instead of manufacturing every component in-house, a company may specialize in single part of the value chain, software, hardware, logistics, one of them, and connect with other players through interoperable ecosystem. I mean, we have seen this play out. Huh? I mean, look at Flipkart and Amazon when they started in India. While it was copying Amazon US model, India, they had to reinvent a lot of things for India. Payment gateways not exist, they built payment. Logistics not exist, they had a third-party courier. They had to do their own warehousing, their own shipment. So all of this had to be built integrated. So in Flipkart, in Amazon. Today you want to start, you have multiple third-party players you have APIs, you can connect to a Elastic Run, use load share, use Porter, use third-party players, use delivery, use external warehousing ecosystem, all of that to be able to connect and to be able to build a business. No longer you have to do it. Take Tesla, for example, its approach to battery technology and supercharger network. They open sourced its battery patents, built an interoperable charging network, allowed other EV manufacturers to adopt technology while still competing in the market. So they were competing aggressively, but an open ecosystem. Okay. So accelerates the growth of the entire EV ecosystem by Tesla. We have seen this in India and ONDC. ONDC is a great example. Democratized e-commerce by allowing small retailers to plug into a common infrastructure. This is what I meant by modular system. Access a large customer base. You are a small handicrafts maker in Jaipur, you can access a large customer base. Don't have to build your own platform. So there's a level playing field because of the modular ecosystem. So I think this modular ecosystems, companies collaborating in multiple areas while competing fiercely is a great example for innovation and new age business models.
I think we have almost run out of time, but I will ask one last question. After this lovely book, uh, is there a sequel to it that you are planning to write, or what other plans do you have, especially when it comes to your foray in the publishing domain?
Right now, I'm still in the process of launching this particular book. One of the challenges of this kind of a topic or sector is things change so fast. So, what I'm thinking is at some point of time, after a bit of more evolution of this generative AI, would love to delve deeper into how generative AI is changing the core business model and what is the impact of it. I wouldn't hazard for it now because things are changing almost by uh, the week in the generative AI space. So maybe when the dust settles down and some kind of normalcy returns, generative AI impact on new age business model would perhaps be my next area of interest.
And I'm absolutely looking forward to that. And I must say that your the post on LinkedIn that you had shared, I think a month back or something, which showcase your mother reading the book was extremely heartwarming. So I had to add that towards the concluding part of this interview.
Thank you very
And
much.
I'm hopeful that that you enjoyed. I enjoyed being in conversation with you, and here's looking forward towards more such work from your side.
Thank you. It's a pleasure for me to be here.
Thank you, Ganesh. Thank you so much.